Welcome back to Squawk Box, the CNBC All-America Survey. It is out, and our own Steve Leisman is at the table. He's got the results for you.
Good morning, Andrew. Tariffs look to be taking a political toll on President Trump, along with uncertainty and inflation. The CNBC All-America Economic Survey finding President Trump's approval rating at 44%, with 51% disapproving. While it's negative, it's slightly above where he was when he left office in 2020. But the poll finding is economic approval at 43% compared with 55% disapproving. It is the lowest economic approval in any CNBC poll while President Trump has been in office, and his first net negative showing on the economy. The president maintains strong support from his base, but he's deeply underwater. That is approval minus disapproval on the economy, with Democrats and independents together. In the survey of 1,000 people nationwide, the president has strong support on protecting the southern border. That plus 12 net number you're looking at on your screen or listening on the radio reflects 53% in favor and 51% opposed. He also has a majority favoring his policies deporting illegal immigrants. But the public, net negative on his actions to reduce federal government spending and the federal workforce, as well as on foreign policy, tariffs, and especially inflation. Support from his own party, it's still strong on tariffs, but you can see it's below their overall approval of the president, and it's well below water among Democrats and independents. They are lower still on the issue of the president's handling of inflation. Views on the outlook for the economy show that December bump in optimism from the Biden era that greeted President Trump's election, well, it's now been wiped out. The 49% who think the economy will get worse is the highest since 2023. Republican pollster for our poll, Michael Roberts from Public Opinion Strategy, said we're in a turbulent kind of maelstrom of change when it comes to how people feel about what's going to happen next. It's unclear how much these results matter to a president who stayed the course on tariffs amid warnings of recession and a big drop in the stock market. The public's congressional preference, 48-46 for Democratic control, just barely changed from December, so it doesn't look, folks, like the Democrats are picking up much support here, but the president on the economy appears to have lost quite a bit.
I have a million questions about this, but I really have a million questions about what I think you've been thinking about all morning. Can we go there?
Sure.
What do you think? What do you think about what the president has just said about Powell, about the independence of the Fed? And I'm most curious about what you think the bond market actually thinks of an independent Fed leader versus what will happen under when, and there will be a transition no matter what, but there will be somebody who's appointed by Trump, and how they will think about that person, and will they think about that person differently?
I'm not on the third derivative yet, Andrew.
Okay.
I'm still trying to process the first one, which I think we've decided that the president is going to talk about the Fed. Mm-hmm. The difference this morning was this idea of termination. So the question becomes, is he just talking, or is he going to do something about it? That kind of changes the game, and it gets to your thing about what would the bond market. I think the bond market would not look kindly on that idea. The president has said that Powell will serve out his term, as had Scott Bessent, the Treasury Secretary.
Right.
So if that maintains if that's the case, and we're not talking about some kind of precipitous termination here, then we're going to have a debate on policy. Okay? Is the president wrong? I don't think he's on the face of it completely wrong, right? You think about how much the ECB has brought down their interest rate. It's quite a bit more.
You saw Gunlack. You saw his comments.
I didn't see Jeff's comments. No, what did
just saying that if you look at the 2-year, we're at least.
Yeah, Jeff's all about following the 2-year.
We're at least 75 basis points. That it happened last time. There were tariffs put on last time. The Fed waited too long and finally ended up capitulating and cutting.
Okay, but let's put yourself in Powell's shoes here. Guys, I think I have a chart.
Well, now he doesn't want to do it just because he doesn't want to look like he's listening to Trump, which could be a bad way to.
I think if there was a Joe, let me ask you: do you want to roll the dice on this? You feel good?
Who said?
No. You feel good? You roll the dice?
Who said the other day that the combination of the Trump put and the Fed put together could save us?
Are you quoting yourself now? Is that where we are?
Myself. It's not the first time. It's not the first time I've done that.
Seriously.
You remember the other day? I mean, and I'm telling you, I feel it. I feel it from coming the vibes that you're not sure that with these inflation numbers we recently saw.
Good inflation numbers.
And with the cloudy outlook with uncertainty and consumers and everything else, a little 25-pointer here, a little 25-pointer, good for what ails you.
I would not.
May.
Joe, what are you looking at? What do you
May.
tell me what your June inflation number looks like?
I don't.
Let's
I'm
forget
not,
about May for the moment.
I'm not.
Tell me what it looks like.
I'm still
No, no, no,
I'm still hopeful. It's a one-shot deal.
If you're going to play the game.
I don't think the second derivative builds from tariffs.
Okay.
And I think oil at 60,
you are willing,
oil will tamp that. Oil at 60 will make up for the tariffs.
Let's do this. You are willing, in the face of what could be a 1 percentage point, for example, increase in the CPI.
Yeah, I don't think that.
You don't think that happens?
No.
Not even on the first derivative. Not even the first time around. Not even the first impulse of tariffs.
I could take it.
You're willing to say my
I could take it
inflation number
it's
is
not
going up.
It's not a systemic, built-in.
You are sure about
inflation.
that?
I'm pretty sure, and I'm a damn good. I could be on the Fed.
Okay.
Easily. In my spare time.
Now, if Biden was in office, would you make the same call?
Oh my God! I mean, we were so screwed up then that I wouldn't even try to help. No, I wouldn't.
Okay. Look, here's the way I see the Fed's dilemma. I'm not so, what's the right word, unhumble as to make the call that Joe made.
You make them all the time.
I am a little bit more humble before the fates.
You make them all the time.
Kelly, let's do this, okay? Maybe Kelly can help me.
Go to Kelly here.
Go to Kelly. You are the Federal Reserve. You just went through a surge of inflation.
Yeah,
you see near-term inflation expectations are higher. You have a forecast yourself before these tariffs came through of a 2.8% core PCE, which is about a percentage point higher than your goal. You're looking at the largest tariffs imposed, greater than Smoot-Hawley, according to Powell, larger than you expected when you wrote down your numbers on March 19th. You expected some. And then you're going to say, okay, I am concerned about my credibility, and I'm going to cut interest rates in the face of that.
I think they hurt the economy. I think they're dovish on the margin. And I don't think that's a communications problem. I think they're just scarred from what happened during the pandemic. And the jury is out on how soft the economy will be.
Forget all that.
If it doesn't soften,
what's your call here?
Then I would be biased towards cutting.
You would cut.
It's going to hurt the economy on the margin.
Okay. I lose. That's fine. I lose.
Also jawbone the potential cut.
I don't lose it.
I'm a loser.
Play the jawbone.
You don't play the jawbone?
Well,
meaning you could jawbone it, meaning
you could use the guidance.
It's a guidance story.
They could do the dots. They could use the dots to say.
So what do the dots say? How do you solve that?
You use the dots and you say inflation's coming down, the core, central.
But it's not.
No, but you use the dots.
It's not. You are cutting literally
like 6
in the
months
face.
From now. 6
you are
months
cutting
from now.
literally in the face of a surge in inflation.
Right, but people understand it's acting like a tax.
So you are not concerned with controlling inflation expectations?
No, I think they're already gone. You've lost them. You've lost the inflation expectations.
But then how can you cut?
You might lose the economy.
But how can you cut?
That would be to support it. To support it. That would be the only reason.
But you've just let inflation expectations go out of control.
Yeah, but it's because of a tax shock, not because of a sustained, monetary. I'm just saying.
But you just lost inflation expectations.
No, we got a slowing economy. We got oil at 60, under 60 something.
They're already gone, but they're acting like a tax. Like if you said taxes are going
up, you
up,
have to control them. That's your job.
Right.
You can't say they're already gone.
They're gone. They're gone. They're already the worst.
If inflation expectations are out of control, your inflation's out of control.
We got to go.
We got a lot more coming up in just a moment.
Okay.
Peter Krause is going to join us, the chairman and CEO of Aperture Investors. He's going to give us his view of the current macro environment. Maybe he'll get in on this debate, moves to de-risk, and maybe find us some safe havens when we return.